Hello, I'm Andy Hodges. We thought we would here at ZTN try and unpack the inflation figures for you and try and put it into words that you can understand. Now, Zimbabwe hit a 10-year high inflation rate of 175.66% in June, up from 97.85% in May. That was said by the country's statistical office. But listen to this, on a monthly basis, consumer prices rose 39.9%. Consumer prices, of course, is what me and you would buy normally in the shops, or what consumers buy. We and you are consumers, compared to 12.5% in May. Now, what's troubling, of course, however, is that me and you both know that prices in the shops are rising fast. And in fact, some people believe that the inflation rate of 175.66 is actually understated and should be higher than that. But listen to this, the food basket inflation was 251.94%. So what happened? Well, during that period, if you think about it, the exchange rate on the interbank market rate was trading at about 6.5. And on the street market rate, it was trading about 8, 9, or 10. And actually, it didn't really move very much from there. So you can't really say that the exchange rate that was being traded was a cause for such a huge increase in food prices, because food prices went up by almost 200 to 300, in some cases 500%, of course, hitting us all in our pockets. And also, we were holding $1 billion in nostro accounts in banks, so the foreign exchange was in the marketplace. So what actually happened? Well, the belief is that retailers and manufacturers were pricing goods, were pricing basic commodities based on the price that they thought it would cost them in the future. In other words, if they were buying currency at 8 to 1 in the parallel market or the street market rate, they would price it at maybe 15 to 20 to 1, and as a result, pass that cost onto consumers, what they call replacement cost. So as a result, of course, prices of goods and services went up by that astronomical figure between May and June, and actually continued going up in July between 200, 300, and in some cases 500%. So what does the future hold for us? Well, by the end of the year, analysts and I believe there will be further pressure on inflation, fed by several factors. Obviously, we've got price hikes for essentials such as fuel and electricity. We've got salary increases for civil servants, and issuing of more government debt, and the minting of more Zimbabwean notes and coins. In our case, we know them as the bond note, but of course now they're called the Zimbabwe dollar. Let's start with fuel. Now, as you know, fuel now is being bought from the Reserve Bank at a price traded in the interbank market rate. The interbank market rate currently sits at 8.5, and fuel prices, as you know, have just gone up over $6 a litre. So you can anticipate there will be increased fuel prices in the very near future, at least to $8.5 to $9 a litre. Look at electricity. Electricity, we have not had a tariff increase for the last 10 years. Every year, ZESA goes to the government and asks for a tariff increase and are rejected. We now have not just only the lowest electricity in the region, but possibly the lowest electricity in the world. And in fact, the Minister of Finance himself has stated that he anticipates that ZESA tariffs, which are too low, will be going up in the very near future. So anticipate electricity price rises. Now, what about salaries? Well, we already know civil servants are negotiating with government for a salary hike, and there is pressure from just normal private citizens, normal people working in private companies, for their salaries to go up. That is inflationary. Now, why is it inflationary? Well, it's because more dollars in your pocket means that there's more money chasing fewer goods, which means prices of goods will go up. Simple economics, if you like. If there's a demand for a product, the price goes up. It's simple as that. Now, another problem, of course, the central bank. Central bank has stated that they are going to be printing and distributing into the market through a drip-feed process $400 million worth of new bond notes. Okay? So the problem here is this, is that if that's new money, that's also inflationary. Again, it's down to the simple concept that too much money in the market chasing too few goods makes the prices go up. It's that basic, okay? Central bank has said, of course, that they are going to replace the 400 million. They're going to put the 400 million new notes in and take 4 million out. However, it's not transparent. People don't really understand what's happening. People can't follow what the central bank is doing. Are they only printing 400 million? Will they print more, particularly in line with the salary pressures coming through? Either way, If people see that money coming into the market, confidence is a problem, and as a result, it could be inflationary, and again, could drive the price. And of course, let's talk about the exchange rate. Where will the exchange rate go? Are we going to get back to people pricing goods and services at anticipated replacement price? In other words, what will be the exchange rate in the future? If that's the case, well, then we can still expect prices to go up, particularly of basic commodities. So really, that's the fear. Look, it's not looking so good, is it? However, analysts do think that inflation may slow down in July, August, September. Okay. However, let's not kid ourselves. There are pressures in the economy. There are price pressures in the economy. Things are not at equilibrium yet. Fuel prices are too low. Electricity prices are too low. Salaries in certain cases are too low. Those are all inflationary pressures coming in the economy. So do we anticipate that there will be future price rises in the near future? Well, I think they may be. What do you think? Get hold of us on our Facebook page, Zim Papers TV Network, or of course on our website, ztn.co.zw. I'm Andy Hodges.